Supply and demand is a simple process of finding imbalances. Stocks only go up when there are more buy orders and sell orders and vice versa. This creates an imbalance. You don't need indicators, you don't need moving averages, you don't need news. All you need is price action. And so a lot of people think you have to pay for different things or have different things in your chart. And you see a lot of people post stuff on Twitter or whatever with a million lines and all these things all over the chart. You don't need any of that. So that chart to the left is the most basic way you can look at buy and sell. So this is just a chart that I pulled off of one of my favorite stocks. So as you can see over here on the left, this is called, we're going to cover this in a second, but a rally base rally. And you can see the price rallies out of this, and this chart is Roku, but it goes about 60, I think this is about $60 higher from this level. Comes back, the next time it tests it, it goes straight back up. And that's really what this is all about. It doesn't go, you don't have to chase price. A lot of people will chase price and try to buy it up $40 higher, and it's too late. So here we go. Supply and demand structure basics. There's 4 different structures that we're looking for. A rally base rally, where you push up, go sideways, that creates a base rally. Rally base drop, drop base drop, drop base rally. Those are the 4 key structures, and every one of those structures create either demand or supply. So I got a few more people jumping on right now. Sorry about that. But you don't need anything else other than these 4 things, because this is what creates demand. For a price to go up, there has to be more buy orders and sell orders. So when the price goes up, and that means there's an imbalance. There's too many buy orders and not enough sell orders. So that means there's leftover orders at that level. And we'll go over this more as we go on, but I just wanted to cover a couple examples. I sent out this chart in the option swings tab, I think last Wednesday. So this is a daily chart of Apple. As you can see, we got a major gap down from the 277 level, somewhere around 277. We got a major gap down to about 245. You don't have to chase price here. You don't want to think, okay, it gapped all the way down. Let me buy it, or let me sell it now. Let it come back to test the zone. Next time it tests the zone, now look at the chart. A major gap down even lower, and ends up going into the demand zone before it bounces again. So this is just a basic structure of how this works. Next chart, I posted this yesterday, and this is when I really thought I should share some of this stuff, and I know I'm going quick, so we'll go over some charts here in a second, so I wanted to get through this quickly. But what you've got here is you've got a drop, base, and starts to drop. And then you see in the blower chart, you've got that base that creates, and it comes back up, tests it, and drops another 150 points. So this is just the basic structure of how it works. And when we go through the charts, this is going to make more sense because I'll draw them out before they happen. But last thing I wanted to cover on the PowerPoint is, when does this not work? Really never. It's hard to say something never doesn't work, but the key of this, the larger time frames are always going to work. It's always about supply and demand. It's what the stock market always has been, and it's what it always will be. And so the only time that it won't necessarily work is when you're just wrong. You're looking at too small of a time frame. So if you're at monthly supply and then you're looking at daily demand, your monthly supply is going to override the daily because it's a larger time frame. So the larger time frame prices will always beat the small time frame. So you could be wrong, but it doesn't mean that supply and demand didn't work. And then catastrophic news is the other piece, that sometimes you may be looking at a daily demand, and then something like the coronavirus or 2008 or 9/11 happens, and the big banks and institutions get rid of those daily orders. They pull their orders, they cancel them because they know they're going to get a chance to get in lower at weekly or monthly demand. So I know I went quick through that, but that's kind of the basics I wanted to show you really quick. And then I'll go over to some charts. Let me share these charts with you guys.
Does everyone know what a gap down is? I guess real quick, a gap down is just like a big movement in price overnight. So
Yeah.
like, let's say Apple was at 300 yesterday and it opens up at 295. That's a gap down.
Yeah, so I think the key to the gap down is using these charts here are called candlestick charts.
Yeah.
And like on Robinhood, it's just a line chart. You can click on it to get candlestick chart, but you can see where things gap down with candlestick charts. So I've got a few zones already drawn on this chart, and I'll go through kind of what's going on. And I'll start back to 2014. So this is a monthly chart. So this is the largest time frame chart. So if you're looking at monthly charts, like we've got a major drop in price, right? We went from 3,400 down to 2,300. That's a major drop in price. So you need major imbalances to counter that, right? So when you look at, if you go back to 2014, you can see we kind of get, we are down here around 1,600. You get a rally, base, rally, right? So from here, from this imbalance where it rallies for the second time, you run up and you get 262 points to the upside. It's a $26 move in SPY. So that's a large push up. So really quick, this is just ES, which is the futures contract for the S&P 500, which is the same as SPY if you're looking at Robinhood or anything else. So so really quick, that's about the imbalances. So then you see the next time it comes back down to test this zone, it goes right back up. Comes back to test this zone again, goes right back up and never comes back and goes flat. It touches this price and it goes all the way from this price to $4,000, right? And it never comes back to test it. So those are the kind of moves that you can get with these monthly demand zones. You'll see again right here, you get a rally, a base, rally, comes back, tests it, goes higher, right? Right here, rally, base, rally. And I'm just showing you guys demand zones first, but rally, base, rally on a monthly time frame. 2018, tariffs come into play. Everybody thinks the market's going to melt down. It touches, skyrockets, right? Everyone thought when the tariffs came into play, oh, this is the end, it's going to go way down. Everybody sold it, the banks bought it, it goes higher. So this is the key. And then I'll go to some smaller time frames. I'll get rid of some of these lines since they're so far away and they've been tested. So I'll get rid of some of those lines and we'll go to a weekly chart and see what's next. So same thing here. You see it test down here, skyrockets. So if you look at a weekly time frame, so we showed you some of the rally-based rallies. So this right here would be a drop, base, drop, right? And you see the drop goes into this imbalance, the same imbalance from 2018, right? So December of 2018, you had this demand zone on the monthly time frame. You come in 2018, you test it, right? You test it again last week, and it tests the zone right to the tick, and you get a bounce all the way up, 528 points. That's a major move, $52 in SPY, right? So then I always like to tell people the more times price tests the zone, the less strong it is. Because the more time, if there's 1,000 orders for buys at that level, comes back in 2018, tests it, let's say 500 orders get filled. Comes back in again, tests it a year and a half later, let's say the other 500 orders get filled, pops up. Next time it comes down, there's no more orders to be filled, so it's going to break down lower. So that's really important to know because it's not always going to be demand. So I guess one thing that you could say here is, so you get your rally-based rallies over here, drop, base, drop. So when I'm looking at the charts for what's going to happen on a weekly time frame, next time we get to this level, 28.98, it's a sell. It's a sell because you test this level. I'll make it red so you can see demand versus supply. So red is supply, green is demand. So all you have to do to find these levels is you look for the drop, base, drop, and you take the bottom of the candle and the top of the wick.
Real quick, I don't feel like a lot of people understand fully candlestick like on the charts. So like look at the red one that has the wick going down and you see how it finishes the box on top. So the price hit the green zone and it bounced back up.
Yeah.
Does that make sense?
Yeah, I'll cover the candlestick really quick.
Okay.
So if the candle's red, it means that the top of the base, the top right here, is where it opened, right? It means that the wick means it went up and came back down, tested lower and closed. So the candlestick and the wicks, like this is, so if it's green, the bottom is where it opened, the top is where it closed, the green is where it got to.
Yep.
So I hope that makes sense for everybody. That's what the candlesticks are. It gives you a better reading than just a line chart. So you can see.
Hey,
go ahead.
Explain the red one more time, just for another example.
Yeah, so the red one right here.
Went to and closed.
Red one right here, open. It opened, it started out Monday right here. Right?
Yep.
Tested all the way lower, came
Bounced
back up,
back.
closed the week on Friday right there. If I went down to a daily chart, each candle would be a day. If I went to an hour, each candle would be an hour. So this is a daily chart. This is a weekly chart. So it started out Monday, went all the way lower, came back up to here.
On this chart.
Yes.
Does that make sense for everybody? Jalen?
That makes sense. My sister's with me and she said she understands, so.
Perfect. Okay, so anyways, so back to, this is where I would look to buy puts. So I think the market is going to reverse here. It's a weekly time frame, so it's a large imbalance. That's where I'm going to go the opposite direction, right? This demand zone down here from 22.35 to 21.74 on a weekly time frame goes all the way back to a rally base rally. Never gets retested, so it's a fresh imbalance, and that's why I think we're really close to the bottom, because that's a weekly or a monthly demand zone that hasn't been tested. This 2,500 to 2,300, it's been tested 3 times, and it just broke down this week. So I'm looking for the next area that hasn't been tested, and that's one of them. So that's why I think price is going to reverse right here around, it could get down to probably 2,100. But that's why I think it's going to reverse there, and it's going to be a time to get long. And that's why I've been saying for the last week to be buying a lot of shares of stock right now, because when everyone else is fearful is when you buy. You think Warren Buffett is selling right here? Warren Buffett's buying at these levels because they're value levels, and that's why I've got value right there. But all right, so then you see this is a weekly, and we go down to the daily and see what else is there. All right, so within this, you've got a smaller time frame, right? So this is drop, base, drop. Here's another zone. Bottom of the candle, bottom of the base of the candle to the top of the wick. So that's going to be the next zone that I'm going to look for it to have a challenge to break through. And so a lot of people think, the market's going to go straight back up to the top. Everything's going to get better. It's going to go straight back up. It's going to take a lot of time to get through these levels because of the imbalances there. It's going to take time to get back to these levels. So that's for the daily. I've got some other charts I'll go through too, and then I want to kind of cover what I shared with everybody on Friday and what we were looking for and how we knew it was going to drop significantly. So sorry, I meant to go to 2 hours. So like I said, the larger the time frame, the more significant the imbalance, the further it will drop or rise. So on a 2-hour chart, it's going to take a little bit of time. It's not quite as big, but there's still something significant there. So if we go back to right here, you see rally, base, drop. That's another one of the structures. Let's see what else we've got. Rally, base, drop. That's a good example right there. I'll cover this one. All right, right here, you get a rally, you get a base, you get a drop. Never comes back to test. So 24.74 up to 25. Let's see if I got that right. Here, I'll make it a little bit bigger. All right, rally, base, drop. So right here is a supply zone. So when it drops from this price, we don't know it's going to drop from that price. So this move from The top of this candle, 25.29, never comes back, goes all the way down to 22.71. We don't necessarily know it's going to happen. It's not a high probability. We don't see it coming. So you don't have to chase it. What you do want is you want to wait for it to come back to that price. And you can see you'd get awfully close right here. So you could probably, sometimes I enter a little bit early because sometimes you'll be a little bit short of it. But you get short there and you get a move down. It comes back up, moves back down, comes back up, tests into the box. This is where you want in. So can't remember if it was Lane or somebody was asking on Thursday, why don't we get in puts here? Clearly it was the right idea. It was all about timing. So we got in puts Thursday. And then you remember Friday we opened basically at the same level, right? And so it was like, well, that's not really a great trade. We ended up making $20 on that trade, which is per contract, which is not very good, but we didn't lose it all. I said it was an all or nothing, but you can see where it opens. And then we're like, okay, well, it dropped. We got out at 23.50, right?
It dropped right away in the morning. Then it went kind of back up.
So, all right, so we got in. But then you could see anytime price starts to drop, if you're in a downtrend like we are now, you're going to look for a retest of the zone because on the way down, it will create supply zones. So on a 2-hour chart, we drop from here. Let's say you missed this move, right? You missed this piece of the move, right? There's another demand zone, supply zone that gets created right here. Drop, base, drop, right? That zone gets created, it drops down to here, comes back, retests it, drops much lower. So from that zone, that drop, base, drop, from that
That's where we re-entered put.
You get a 116 point drop. So instead of trying to chase price here, it drops and it spikes up and then you end up getting stopped out. That's not what you want. You want to take an entry at the best level here. And there's times in this market where you're going to get stopped out. You're going to move $3 in 5 minutes. And so that's the challenge and why you have to make sure you're getting the best entries. So if I go down to a even smaller time frame, let's go to 30 minutes. All right, so there's the zone right there. That's the drop, base, drop. Comes down. You don't want to get in this first time because you don't know it's happening, right? You don't see that until it's created the supply. And then it drops down, you don't have to chase it. If you chase it right here and you buy it 23.49, it goes back up, you're going to get stopped out. What you do is you sit and wait for it to come back and test this zone, which it did. And at 23.84, we bought puts, right? And that's when the imbalance was created on the way down. It was a 2-hour supply zone. Tests it 3-4 times, drops ultimately lower. And you have a series of drop, base, drop, drop, base, drop, all the way down. So it's creating 30-minute supply zones all the way down. So when we do reverse, you're going to get a small drop. I'll make that one green because that becomes, that's red. So you're going to get a small drop when price comes back into this level, you're going to get a small drop. So you take the bottom of the base, top of the wick. So next time we come back and test 22.83, it's going to drop a little bit, right? Because it's a 30-minute time frame. But if this was on a larger time frame, like 4 hours, you don't really see anything there. You get a drop, base, drop, and your next level would be right here. So next time we come to 23.75, you're going to get a rather significant drop. But ultimately, the trend's going to end up going back up. So instead of being like a drop, base, drop, base, drop, base, drop, you're going to get a rally, base, rally, base, rally. So when the trend changes, instead of sell the rips, it's going to become buy the dips. All right, I'll go to one more. This is my favorite stock, my #1 stock holding, Roku. A lot of people don't like this one for some reason, but this is one of my favorites. So I drew some things on this one already for a monthly demand and why we turned around at $58. So this is a pretty clean rally base rally, right? So from this level, we get a drop down to, this is 66 down to 56. So on the larger time frames, the zones are going to be a little bit bigger typically because a month, it's going to move more in a month. But as you get down to the smaller time frames, you can take this same zone and look for the smaller zones within that to figure out where you want to enter. What you don't want is to enter at $66 and end up being in trouble. But you can see what happens when it comes back, tests the zone, goes up from 58 already to 75, and it was like 2 or 3 days. So you get a significant imbalance, you get a significant move. We'll go down to a weekly chart. So this is what I do. I start with the larger time frame. So one of the guys in the group a couple weeks ago asked me about PANW. It's Palo Alto Networks. And I don't know anything about the company. I don't follow the company. I don't look at the company. But with supply and demand, it doesn't matter. You don't have to listen to news. You don't look at balance sheets. You're not looking at any of that stuff. You're looking for imbalances. So you can see it comes back, tests this zone, and that's where it reverses, right? So on the smaller time frame, a weekly, you see a tighter demand zone, so you don't have to enter up here, but you know you're in monthly and weekly demand, and that's where you get a reversal. Let's see here. We can go down to a shorter time frame because there's a good supply over here, probably on the daily. You see demand zone there, comes back, tests it, goes higher. All right, here's a daily supply zone. Right there, take those 2 days together. Supply zone goes up, tests it, drops back down, settling. So now that that's been used up, it's going to look for demand. Demand has been recreated right here. Rally base rally. Test it. That becomes demand. So it comes back down, test it, goes higher. If it comes back to $67, I'm buying more. You don't have to go all in at once because you don't always know it's going to be the bottom. So me personally, I took a big position down here at $58. It went higher. I went to a smaller time frame. I got down to, let me see if it was 4 hours, 2 hours. One hour. So you get down to the smaller time frames and you see it creates a demand zone, right? Rally base rally creates a demand zone there, right? Rally base rally comes back in, tested at 62.50, and I added more there. It rallied up, came back, bought more. So I hope this is making sense for everyone. I don't want to make these too complex, but it's really all about rally, base rally, rally base drop, drop base drop, drop base rally. That's really all that you need to figure out what's going to happen. And the bigger the time frame, the larger the move's going to be. Here's another good one. You can move this to, this was a weekly, but you can move it to, I think we're on the 30-minute charts. So 30-minute charts, we close up here, we gap down to here. So what you have to imagine is that this is a large, so this is a rally base drop. There's a candle in between here, even though it's an overnight drop. So you take the top of this, or the bottom of the wick to the bottom of the basing candle to the top of the wick, and that's your supply zone. And then look, it came up, tested it, goes back down. And this is on a smaller time frame, so it doesn't move as far. I can go over Apple really quick, and then I'm happy to go over, I'm not sure how much time we've got left, but I'm happy to go over another stock if somebody wants to recommend one or wants something. answer any questions if you've got time as well. All right, so imagine that in between this candle and this candle, this is a gap down. So it closed right here at 275. It opened up at 256, right? So imagine that there's a candle in between here that took it all the way down, and it would be a red candle, right? So you've got drop, base, drop. So what I do is I take, that becomes, there was a lot of sell orders here for it to close here and open here. Somebody had to sell. It's the only way it works. So that creates this daily area, creates a supply zone. You don't have to chase price, let it come back to test, comes back, test here, drops all the way down. And from this zone, you get a $41 drop in Apple in a day, 2 days. Comes down, touches demand, right? Touches demand at 237. As soon as it touches it to the tick, it goes right back up. So right there, you get a little bit less than $16 move, it looks like.
Whenever you get a chance, Darren, kind of explain why we've kind of changed from day trading lately to, or from swing trading to day trading, because what used to happen was these moves were.
Yeah. So if you look at, I'm not big on indicators, like I said, but I shared this the other day. This is, I don't really consider this an indicator. It's just the range, the average range. So if you go back and you look at, this is insane. You look at a daily chart. The average day is moving $4. This is an Apple. $4, $4, $4, $4. And then we get to now, and the average range of Apple is $17, $16. So that means on an average day, Apple's moving $16. That's why the premiums are so high. If you go to ES, which is SPY, the S&P 500, you've got 20,
zoom in a little bit more.
20.
Show them like the tariffs versus now.
Yeah. All right. Let's see, 2018. All right. Crazy drop down. Everybody was freaking out, right? Tariffs came into play. Big concerns. Apple was one of the big ones. A lot of production in China. Average true range was $70 at the time on ES, which is a lot more expensive than Apple. But 71 was the peak. We're at 170 right now. That means that on average, it's moving 170 points a day. So
which is how much on SPY?
What'd you say?
Which is like equivalent to how many dollars on SPY?
$175. That's $17 on SPY.
Yeah.
That's like 4, 5, 6% a day. So what used to take weeks to happen or days to happen is taking hours. And so when we talk about doing more day trades right now, it's because normally, look at these small candles, all of these candles. This is what a normal market looks like. A normal market, you're going to get, this is a normal market. You're going to have a few bigger days. This big day, 3288, that's $6. There's a $6 move, and that was a crazy drop at the time. But a $6 drop is like an average day now. Look at all of these massive candles, up and down. So we've been day trading because at any point, look at what happens here. Let's say you get a major drop in price here. I think it's going to go lower to this demand zone here, right? But what happens is the next day, let's say we're in puts, the next day gaps down because it opens right here, gaps down and immediately skyrockets. And then you'd be stopped out and you'd lose it all. If you bought puts here, you lose it all. I wasn't wrong that the price is going to go to here, but I would have lost it all on that trade. So that's why it's been, for the most part, trades, because even though we knew it was going down here, because you go from, the market just goes from supply to demand and demand back to supply. That's the way the market moves. That's why it never goes straight up or straight down. It goes back and forth. So you got to find those imbalances. But that's a good point, Jalen. That we typically, for all the new people, we typically are looking for swing trades where you can hold for 2 or 3 days and you're going to get
Bigger moves.
$7 moves to the upside, but those $5, $6, $7 moves are happening in hours, and a lot of times in the overnight session. So there's been a few times I've been in puts overnight. It goes down $6 overnight. I think it's going to be a great trade, and by the time I wake up, it's up $6. So it's a crazy market right now. It's a little bit different than usual. So a lot of times it's more about risk management, which I talked about in the beginning. In the month of January and the month of February, we in a slower market, we were up, I don't know, Jalen, $3,000 a month, $22,000 a month, something like that.
A lot more than we are now.
The group was up, and now I think we're up $500 in a month. But think about how many people are losing money in this market. And so it's really about finding those imbalances and looking for great entries for longs right now. For me, I've put a lot of money in the last couple of days while the market rose to shares, because you can buy shares and you're going to get a $20 move to the upside and you can get out and you don't have to worry about premiums.
Exactly.
So anything else, Jalen?
Try to explain options premiums a little bit, just like 1 minute.
Yeah. All right.
Like
So
what used to cost $2 or $200 is now $800. So like your percentages on a contract for your gains are terrible.
yeah. So, and this goes back to the average true range, the ATR. So when you're back here, if the average move is $41 or $4 in SPY, if your average move is $4, then the options are pricing in a $4 move. So you need to get a lesser move. If it's moving $175 a day, the options premium is going to be higher because they're not going to let a contract go from $1 to $2,000 because it could drop $20 in a day, right? So premiums are just really high right now because options price in like assumed moves. The expected move is already priced in. So like yesterday, we entered up here, we sold it down here, and we got a major drop, right here, and sold it down here. And I think the contract was like $600, $610, something like that. And we sold it at $9, and there was a $10 or $11 drop in price, and yet you only make about 50%. In a normal market, if you got a $10 move, it's a lot bigger win than that. So it's just about being smart about the right time to trade, and it'll get back to a better time to swing trade. And that's when we'll really thrive, because it's hard for a whole group